It's interesting to look at a chart of oil right now because with the exception of that spike we saw once again in mid-late July with the escalation of attacks, the U.S. resuming strikes against Iran, we've been pretty range-bound in this $80 to $90 range. Is there anything that materially can break us out of that, or is this the new status quo for the foreseeable future?
So I think there's a couple of things that break us out of that. I think the first is if we see the flows that have been transiting Hormuz, and that number is widely debated, but significantly higher than what analysts originally penciled in. So if we're looking at 7 million barrels flowing through the Strait, which is kind of between the low and the high end of, 5 million barrels on the low end and Chris Wright's 9 million barrels, if we start to see that number materially decline below 5 million barrels a day due to increased kinetic military action, that will break us out of the range. The second thing that will break us out of the range is if the Red Sea becomes more of a target by the Houthis. Right now, Saudi Arabia is avoiding the Bab el-Mandeb, transiting north through the Suez. If we start to see the workaround to the workaround be impacted, that will break us out of the range. And the last thing is if we see China materially increase their imports from around 7 million barrels a day back up to 11 million barrels a day in coming months, that will break us out of the range, assuming that flows have not fully resumed. So I think those are the keys that break us out to the upside. To the downside, what breaks us out of the range is clearly normalization of flows through Hormuz at the same time that we have non-OPEC supplies increasing.
Okay, Rebecca, so that's what we should be looking out for. But what's driving decisions today? You've got WTI and Brent both down about 1.5%. Who's selling oil today and why?
So I see this as maybe a little bit of profit taking. If you look on the week, we're up 4%. And what I see more than the selling is just a lack of conviction of buying. It's a buyer strike. There is just no threshold for pain to own crude into a weekend where you could get rhetoric around a peace deal or that more flows that we thought were going through the Strait are moving through. So I actually think the threshold for where buyers step in is just so much lower than where we're at right now. It's kind of in that low 70s range where there's some conviction. And for now, the traders are really letting, the profit taking and the downside expressions through puts kind of drive the trade action. So I don't see this as panic selling or aggressively putting on short positions. I see this as more, I'm not willing to step in at this point. I want to see more concrete information. I want to see the China data really, if I'm looking at fundamentals, improve before I start getting really comfortable buying crude at these prices.
Well, so you're looking at China data, I'm assuming in terms of demand, Rebecca. You also raised China in terms of one of those potential breakout scenarios. If you start to see them coming back as a material buyer in a limited supply scenario, is the entire trajectory of the oil market by and large now dependent on China?
It's not entirely dependent on China, but they are the largest importer of crude, and they have been one of the most significant buffers to this event over the past months. So are they the key to this puzzle? They kind of are in the short term. Now, over the long term, there's so many more factors that we need to look at. But over the very near term, what China does really does tip this supply and demand kind of scarcity surplus story on its face. So that, for me, that really is the key over the coming months, in addition to obviously flows moving through the Strait. But China has really been incremental in keeping prices from moving above this $100 a barrel range. They've drawn stockpiles, they've shifted away from crude, gone to coal, they've reduced their exports of products. They did reverse that, and we are starting to see China export some products now, which when we look at how tight the product market is really critical. So yes, to give you a short answer, I think in the short term, China is the most important factor.
Interesting. When we consider the refining bottleneck, we add another layer here, Rebecca. We're at $4.07 nationally for gasoline today. It's $5.40 for diesel. And you have pointed out that refiners have been pushing back maintenance for some time now. And at a certain point, they won't be able to do that anymore. When you consider crack spreads and where gas and other distillates are going, how worried are you about refinery outages?
I'm pretty worried. I mean, we're running at 96% refinery utilization at this point. Almost every refiner has pushed back maintenance to capture the crack spreads that are extremely elevated. You can't do that continually. There will be something that breaks, and that will cause an outage that lasts longer than potentially maintenance would. So that to me is a huge risk. We've already lost 20% plus of refining capacity through the Middle East and Russia and China reducing their runs, right? We don't have anything left in the system if something surprise happens. We saw Libya lose a little refining capacity earlier this week. There's no buffer here. So I do worry about this maintenance season. If refiners do go in maintenance, keep in mind that keeps the product market tight, right? We're losing that ability to bring product to market, and actually weighs on crude. But that's a better solution than creating a system flaw or a fire that keeps things offline for longer than the maintenance period. I
or
tend
God
to
forbid
think
we have a hurricane.
to start to see maintenance now. Did I lose you?
God forbid we have a hurricane. I mean, that would be a game changer, no?
That would be a game changer. I mean, it is an El Nino year, and it's predicted to be less of a factor this year. But listen, you just never know. So yes, another huge risk on the horizon.
Okay, so can we look out 82 days on the horizon specifically as we approach Election Day? Do you have a best guess of where retail gasoline and diesel prices will be early November?
I don't have a best guess, but I don't think it's going to be as low as the administration would want it to be. So I guess I would say it's going to be higher than the pain threshold for many in the administration, and probably not as high as the extreme scenarios that people are talking about. So if I had to put a range on it, I would kind of put it in the 4 to 425, 430 range of where we see gasoline prices. And I think diesel, a little bit more of a wild card, remains above 5. Maybe we see 556 in a bad scenario. So I think that's what the range is. It's not significantly lower than where we are today.
Interesting. Just lastly, Rebecca, we're back to this reluctance to go long into the weekend. That continues until there's a breakthrough. We've got about 30 seconds.
So I think it does continue. I mean, if you just look at how traders have been nicked up this year with headline risk, and it's the middle of August, the threshold for pain is low. And I think that buyers are going to say, you know what? I'm willing to miss this 5% move higher because I do not want to lose 10% to the downside.